6 o'clock, Sunday evening, March 22nd, 2026. And in the time it took you to read that sentence, the entire Western financial establishment just got exposed. Not slowly, not gradually, not over weeks of market correction, in 60 seconds. The CME Globex servers came online at exactly 6 p.m. Eastern, and the paper price of silver, $67.69, the number that Wall Street spent all of Friday carefully engineering, didn't just drop, it didn't just correct, it ceased to exist. Vaporized, like someone reached into the system and deleted a lie, because that is exactly what happened. Tonight, I'm going to show you the crime scene. Tick by tick, number by number, I'm going to show you how Friday's crash was manufactured, why Sunday's open obliterated it, and what this means for your money, your savings, and your understanding of how markets actually work in 2026. Stay with me, because by the time this video is over, you will never look at a silver price on your screen the same way again. Let's start with Friday, because Friday is where the crime was committed. Silver opened Friday at $71.40. By the close, it had been hammered down to $67.69. That's a $3.71 drop, almost 5.2%, in a single session. And every single mainstream financial outlet had the same headline ready to go. Silver rally over, smart money rotating out, time to take profits. Let me tell you what actually happened. Every quarter, like clockwork, the bullion banks orchestrate what the market calls a paper takedown into options expiration. They flood the COMEX with naked short contracts. Not contracts backed by physical silver, not contracts backed by inventory in a vault somewhere. Contracts backed by nothing, except the assumption that retail investors will panic and sell. On Friday, March 20th, traditional options expiration, they ran the play perfectly. High-frequency algorithms poured sell orders into the market simultaneously. The price collapsed, stop losses triggered, retail traders panic sold at the worst possible moment, and Wall Street called it a market correction. It was not a market correction, it was an extraction event. A surgical operation designed to shake silver out of weak hands at artificially depressed prices so that institutions could cover their short positions and reset for the next leg up. But here's what they miscalculated. They forgot that the market reopens Sunday at 6 p.m. They forgot that 790 tons of physical silver has already left Western vaults. They forgot that Shanghai doesn't sleep, and that arrogance, that institutional hubris, is why tonight's open looked nothing like what their models predicted. Here is the number that should terrify anyone who is short silver right now. COMEX registered silver inventory, the silver that is actually available for delivery against futures contracts, as of March 20th, 2026, stood at approximately 28.1 million troy ounces. That is the lowest level in 22 years. We have not seen deliverable silver inventories this low since 2004. Now, here's where it gets critical. Over the past 2 months, the Shanghai Gold Exchange, the SGE, drained 790 metric tons of silver out of Western vaults. Let me convert that so the scale is impossible to ignore. 790 metric tons equals approximately 25.4 million troy ounces. Now do the math. 28.1 million registered ounces minus 25.4 million ounces drained by China equals 2.7 million ounces remaining. 2.7 million physical ounces, covering a paper market with open interest representing over 800 million notional ounces. That is a leverage ratio of 296 to 1. 296 paper ounces for every single physical ounce available for delivery. That is not a market. That is a Ponzi scheme with a Bloomberg terminal. And the people on the short side of that trade just found out what happens when physical reality shows up to a paper party. Let me take you inside the CME server room at 5:59 p.m. tonight. The Sunday Open is completely different from a regular trading session. During normal hours, there's a constant flow of buy and sell orders. Liquidity is continuous. Market makers are posting bids and offers at every tick. The spread is tight. But Sunday at 6 p.m. is a cold start. The servers boot from zero. The order book is essentially empty. Whatever orders are in the queue are only the orders placed over the weekend, preloaded, waiting. Tonight, the sell side of that order book was a ghost town. There were almost no resting sell orders between $67 and $72. Why? Because there is no physical metal to deliver at those prices. The entities that would normally be market making at these levels, they don't have the silver anymore. They have paper receipts for metal that is currently on a container ship heading to Shanghai. And then the Eastern buy orders hit. Chinese quant funds, sovereign wealth vehicles operating through Singapore and Hong Kong. Massive institutional buy programs preloaded over the weekend, designed to exploit exactly this moment, the moment when the Western order book is empty and the physical cupboard is bare. The matching engine did what it's programmed to do. It searched for sellers at $67.69. None. $68. A handful of small orders consumed instantly. $69. Gone. $70. Thin layer of stop orders from trapped short sellers, eaten in milliseconds. $71. $72. The engine entered what we call a liquidity void. The price didn't climb, it teleported. It quantum leaped from level to level, skipping every price point in between, because there were literally no sellers at those levels. The average Sunday open gap for silver over the past 5 years, between 5 and 30 cents. Tonight, we saw a move of over $7. That's 23 times the average in 60 seconds. Let me walk you through exactly how the margin call cascade works, because this is why tonight doesn't end at midnight. When a hedge fund holds a short position in silver futures, they're required to maintain collateral in a margin account. The CME's initial margin requirement for one silver contract, representing 5,000 troy ounces, is approximately $19,800. Maintenance margin sits around $18,000. Every dollar the price moves against a short position comes directly out of that margin account in real time. So, let's say a hedge fund is short 1,000 contracts. That's a position representing 5 million troy ounces. Tonight, the price gapped $6.31 against them. Do the math. $6.31 multiplied by 5 million ounces equals $31.55 million in losses in 60 seconds, while they were eating dinner. The maintenance margin on 1,000 contracts is approximately $18 million. If their account had less than $49.5 million in it, they just received a margin call. And here's the domino. It's Sunday night. Banks are closed. Wire systems are in weekend mode. They cannot get fresh capital into the account fast enough. So the exchange's own risk management algorithm begins automatically liquidating their short position. And how do you liquidate a short? You buy. You buy to cover. The exchange's own computer is now placing massive buy orders into a market that already has no sellers. The buy pressure pushes the price higher. Higher prices trigger margin calls on other short sellers. Those margin calls trigger more forced buying. More forced buying pushes the price higher still. This is the cascade. Self-reinforcing, unstoppable. And the people on the wrong side of it are the entire Western bullion banking establishment. Let me give you the full scale. The Commitment of Traders report from March 17th showed managed money, hedge funds, held a net short position of approximately 47,000 contracts. That's 235 million ounces of exposure. At a $6 move against them, $1.41 billion in losses. The swap dealer category, the major bullion banks, held an additional 31,000 contracts short. Another 155 million ounces. Another $930 million in losses at the same $6 gap. Combined, approximately $2.3 billion in aggregate short-side losses. From one 60-second gap up. On a Sunday night, this is not a market correction. This is a wealth transfer from paper hands to physical holders. I never make a claim without showing you historical precedent. So let me give you 3 comparisons, because this has happened before. 1980, the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt attempted to corner the silver market by taking physical delivery. They accumulated roughly 100 million ounces. The COMEX panicked and changed the rules mid-game, implementing liquidation-only trading, rewriting margin requirements overnight. The price collapsed from $50 to $10. But here's what the textbooks don't tell you. Before the rule change, the price action looked exactly like tonight. Massive gap-ups on opens, empty order books, margin call cascades on the short side, identical mechanics. The only question in 2026 is whether they change the rules again, and whether they can do that when China is the one holding the physical metal, not 2 Texas billionaires. 2008, the financial crisis. When Lehman collapsed in September 2008, the paper price of silver fell below $9. But if you tried to actually buy physical silver in October 2008, you couldn't find it for under $14 or $15, a 60% premium above spot, because the paper market had completely disconnected from physical reality. Tonight, the same divergence is playing out, except this time, the physical price is leading and the paper price is being forced to catch up. 2020. COVID crash. Silver's paper price fell to $11.64. But go find one American Silver Eagle for sale online during that week. Every major dealer was sold out or charging premiums above 100%. The paper said $12. The real price was $24. The people who bought physical at those premiums are sitting on 300% gains today. The pattern is always the same. The paper price is a weapon, not a measurement. It is a tool of psychological warfare designed to shake you out of your position at the worst possible moment. Tonight, the weapon backfired. Why is China draining 790 tons of silver? Why now? Why this aggressively? The answer is sitting in China's 14th Five-Year Plan supplementary industrial policy documents. Published in Mandarin, nobody at CNBC reads them. I do. China is building the largest solar energy manufacturing base in human history. Their stated goal: produce 80% of the world's solar panels by 2028. Silver is a critical input for photovoltaic cells. Every single solar panel requires approximately 20 grams of silver for its electrical contacts. At China's scale, they need 15,000 to 20,000 tons of silver over the next 5 years, just for solar panels. Global mine supply runs approximately 26,000 tons per year. That means China needs roughly 15% of the entire world's annual silver production for solar alone. Add electronics manufacturing, semiconductor fabrication, and military applications, and you're looking at a country that needs 25 to 30% of global silver supply every single year for the next decade. And here's the critical distinction. China is not buying silver on the COMEX at paper prices. They are buying physical silver, taking delivery and removing it from the global float permanently. When 790 tons ships to Shanghai, that metal is gone. It doesn't get relisted. It goes into strategic reserves or directly into manufacturing. It exits the Western financial system for good. Layer on top of that the BRICS settlement framework announced at the 2025 Kazan summit. The Enbridge cross-border payment system, now in advanced pilot with participation from over 40 central banks, allows bilateral trade settlement in local currencies, bypassing the US dollar. And critically, the BRICS stabilization mechanism allows participating nations to settle trade imbalances using commodity baskets, including silver, priced at physical market rates. They do not recognize the COMEX paper price as a valid benchmark. To the Eastern Hemisphere, $67 was a joke. $67 was a paper fiction that bore no relationship to the physical reality of a metal essential to the global energy transition, the semiconductor revolution, and the military-industrial requirements of every major nation on Earth. Tonight, physical reality showed up and corrected the fiction. Live. On your screen. So what happens from here? The Tokyo markets open within hours. The SGE night session is already active. The Hong Kong Open is coming. The buying pressure compounds as each Asian market comes fully online. The margin call cascade doesn't stop at midnight. It intensifies as each new wave of forced liquidation hits an order book with no sellers. By the time New York wakes up Monday morning, the financial landscape will look fundamentally different than it did when they went to sleep. And the mainstream media will spend Monday morning trying to call it a flash crash, a technical glitch, a fat finger. It wasn't any of those things. It was the market telling the truth for the first time in months. Here's what you do now. You hold physical metal, not an ETF, not a futures contract, not a bank vault, in your hands, in your safe, in your possession. Because when the rehypothecation chain snaps, and it is snapping right now in real time, the only silver that matters is the silver you can touch. Physical silver cannot be margin called, cannot be automatically liquidated, cannot be frozen. Your physical stack doesn't have a counterparty. And tonight, the counterparties are blowing up. Wall Street can manipulate the close. They proved that Friday. They can flood the paper market with naked shorts into options expiration and make it look like the bull run is over. They've done it 1,000 times. But they cannot stop the servers from booting at 6 p.m. on Sunday. They cannot stop Eastern buyers from showing up with 790 tons of conviction. They cannot deliver metal that doesn't exist. The close is a lie. The open is the truth. And tonight, the truth just hit the market like a freight train.